This is the starter kit, so at the very end, for those of you who'd like to meet with me at no cost or obligation, this is what you'll take with you to fill out, and then there's a list of documents at the top. So at the conclusion of this workshop, if you want to meet, all you do is down at the bottom of the sheet, you check the box to meet. If you're not interested in meeting this time, that's fine. You can just check the box where I can call you. If you don't check any boxes, we don't do anything. I like to give away things. So this was my first book, The Worry-Free Retirement. So we do encourage audience participation, so whoever has some great comments or a great question, I may be giving you this. And then my second book, Don't Follow the Herd, I'll give this away as well, so good reading. We just came out with these. One of the things, you may have seen this if you watched the show today, these little booklets, I'd like you to take one of these with you. Great little booklets on Are You a Saver? All right, the industry unfortunately has gotten so big with this concept of talking about safe money and workshops, things that I'm doing as well, that I've really been working hard the last year on this whole concept of personalities of money. And I really do believe people are predominantly either a saver, speculator, or investor. First of all, I like to start off saying annuities are contracts. They're not really, they're investments, everybody calls them investments, but they're really contracts. So let's think about, has everybody ever signed a real estate contract, either buying a house? Okay. Is the contract an investment? No. A contract's a legal agreement with one party agreeing to do something and the other party agrees as well. So ma'am, I'm agreeing to buy your house. I'm going through this right now, we're selling our house. Buy your house for a certain amount, I sign off on it. You sign the contract saying, yes, I agree, and then we exchange there. But a bank does all that, but it's still a contract. An annuity is a contract. It's a promise from the insurance company. When you give them your money, insurance company agrees to certain terms or conditions in exchange for the annuitant, that's you. The annuitant is the person that's going to receive the money and is applying for the annuity. So in exchange for that, you're really giving them a premium. Okay? So what is this? What are annuities really for? In our case, I like to call it mailbox money. So let's read this again. Annuities are contracts issued by insurance companies whereby the company agrees to certain terms or conditions in exchange for the annuitant, that's the person applying for the annuity, giving to the company a premium in exchange for a monthly payment to the annuity for something Tony calls mailbox money. Everybody with me? That's a lifetime income you can never outlive. All right, let's go over the 4 types of annuities. The oldest type that exists out there is called a fixed interest annuity. Now, if you ever see the word fixed in front of annuity, that means it's a non-securities product. It's guaranteed. It is not tied to the stock market. Now remember that? Fixed. All right? So what happens on this? This is very similar to a CD. Right now, our fixed annuities, we have a 5-year fixed annuity with a well-rated company paying about 2.8% guaranteed for 5 years. Not bad. So if somebody says, well, I want this money in 4 or 5 years, I just want to earn some decent interest, but I want it guaranteed, fixed interest would be a good idea. So you would put the money in this case, $100,000. If it pays $27.50 a year, you can have the interest sent to you or have it compounded. It's tax deferred. It's a nice little feature. Does that make sense? Now the beauty of this is, if the interest rates ever went down, okay, whenever you make money with a fixed contract, even if interest rates go down that next year, you do not lose anything. Okay? So it's guaranteed, plus the interest is guaranteed, you have a new floor. This is a variable annuity. So there is no floor. Whatever you make the prior year, you could lose the next year, just like the stock market. And you'll see in a minute, very, very high fees. Variable annuities have their place, but I don't think they're good for savers because of the risk and the fees. Most savers don't like risk and fees. That's why we don't do variable annuities anymore. Indexed annuities, well, kind of, as I said, I write a lot of these. I love these products. I have 2 of them myself, 1 of my wife. I love them. Basically, it's like the fixed interest, but it's linked to the stock market. It goes up with the market, but when the market goes down, it's a fixed, yeah, you have a new floor. When each year they take the dividends, basically, and put it in the stock market. If the stock market tanks, the cow that produced the dividends, the bonds, haven't been in the market, so they're not at risk. So yeah, there will be years you won't make anything, but I always remind people this is where 0% is actually your friend. Would you rather make 0 or lose 20%? Savers don't like losing money. This is what we call a hybrid, and we'll see in a minute why. It's linked to the market, but it also has the new floor. Two components now going on, the guarantees, but it also has some stock market exposure for you. Immediate annuity, this is like granddad's pension. You can do an immediate annuity. Interest rates are a little low for that, but what you do, give the money to the insurance company, and immediately they start paying the income, and that income can be paid out over a period certain of 5 years, 10 years, 20 years for life. You can leave it to survivors, whatever you want to do. Here's a typical annuity fee sheet with a variable annuity, Debbie. The typical fees, administrative fees, 0.15, all right? Doesn't sound like much, does it? Mortality and expense fees, variable annuities have these, on average 1.15%. Annual fee, I don't know why they put that. I don't know if that's take the office out to lunch. $30 is what they usually charge. Asset management fee on average is 1.25. See, this is in the stock market, in mutual funds. They have to pay the mutual fund managers. They have to get paid. And then finally, if you're getting an income rider, the rider fees are roughly 0.95. So this is on the lower side on the newer annuities. So every year, Debbie, in this example, we're going to see what this is from a number standpoint. They're going to take out 3.5%. It's a pretty good return for them, isn't it? How much y'all making guaranteed at the bank right now? Not even one? So they get 3.5% for what? You have to ask yourself. Always ask what? What am I getting? Maybe. All right. So let's look at this. So let's say you invested $250,000. There's that annual fee of $350. 3.5, and let's say you did make 5% on average, okay? So the variable annuity on average made 5% just in this example. In 20 years without any fees or anything, you'd have $663,000. So if you took $250,000, the present value of that at 5% in 20 years, you'd have $663,000. This red is the fees. The first year, $9,000, $9,300, $9,400, totals up. The net account value after all the fees went from $663 to $325. That's an account difference of $338,000. Now, I don't know where that money went, but it's gone. Somebody's got it. And here's what's really weird about this. You worked hard to make the money. You turn it over to somebody. In this example, you put in $250,000. How much did they make? $338,000. What risk did they have? None. Pretty wild, isn't it? And you only made then a net of what, $75,000, and after 20 years, what has inflation done to that? It's gone. So fees, you think fees aren't a big deal? They're getting talked about more and more. What really threw this into the forefront is 401ks. The Department of Labor finally made them start showing what fees were, and now everybody's realizing, oh my gosh, I didn't know they didn't have to show it. So now everybody's talking about fees. We've been talking about fees for years. No administrative fee. No mortality and expense fees, no annual fees, no management fees. Average income rider fee is actually less than that, but I gave it the benefit of the doubt. 1%, that's your only fee. And that's if you want an income rider. You don't have to take an income rider. Remember this, every time you hear the word rider, that means something added to the contract. Does it make sense? There is going to be an extra premium. But look at the effect of fees. If you lower it to 1%, does anybody remember what you would have gotten with 3.5? 375 or something, 325, 542. So we just put roughly, well, let's just call it a couple $100,000 in your pocket. Nothing's changed, we just lowered the fees. With an indexed annuity, everything is looked at it on your contract date. Now this could be one of the disadvantages. If you're in a normal investment and you wanted to get out of that investment, sir, you could just call them and get out, right? A stock or whatever, you don't have a contract date. There's really nothing you can do to make any changes in this annuity except on your contract anniversary. So your annuity has a contract date. That's important to know when that date is. Your surrender charges are tied to it. When they do indexing is tied to it. When they credit things, it's all tied to the contract date, and it's different for different people. In this example, I'm going to imagine you put in $100,000. The annuity contract date is June 30th. I'm going to pick on this one because this is kind of funny. This is the one some of my peers get a little excited on. This is called a monthly point-to-point with a monthly cap. You say, what is that all about, Tony? Okay, let's see what happens here. On June 30th, the company is going to tell you what the S&P was. That's what it was, 1362. What they're going to do is they're going to track what happens with the S&P between here and June 30th. And in this example, the S&P was 1606. Pretty nice rate of return. And with a monthly point-to-point cap, what they're saying is every month will give you a maximum of 1.8%. That's the cap. So if you multiplied 1.8 times 12, that's a 21.6 rate of return. You could make that, right? Could. So what a lot of people do is say, yeah, this annuity can pay as high as 21.6. Well, that's, okay. Here's why that's not going to happen. When they do the math on this, this is not a bad crediting method. It's done really well this past year. But you got to understand when they do the math on that, let's see the same thing. Let's say it goes up every month, excuse me. The last 4 days of the contract anniversary, they fly into another building and the market crashes and goes down 25% or whatever. Yeah, actually you take the, you don't lose everything. You lose everything for the year, but you still get zero. Why do you have no losses, even though it went below what you just made? This is a fixed index annuity. You can't lose, see? Now, you didn't make anything in that example because they don't have a floor on their arithmetic. So if you lose money, they're going to subtract the whole thing out. The monthly cap says that each month they're going to look at the S&P. And let's say the S&P went up 4% that month. They're only going to give you 1.8%. They can't give you a whole lot because they're out buying options in the market, so they can't afford to pay the whole thing. Right. They're limited on what they can pay. What I was saying is this last month in this example, when it tanked and went down 25%, they have no floor on their math throughout the year. So even though this was 1.8 up through 11 months, whatever that would be, what is that, about 19% or whatever, if it lost 20, it wipes out your entire gains for the year. A variable annuity or any kind of annuity has a surrender value, a contract value, and then a guaranteed income account value, all right? You with me so far? So in this particular contract, let's talk about the surrender value. If you bought this and didn't understand surrender charges, by the way, there was a question on the show today about class action suits. This is where this is stemming. A lot of the companies we represent are involved in a class action suit. They're going to settle out of court. This is what this is. People would run out and sell these contracts. They wouldn't tell anybody about surrender charges. The people went to go get the contract out. You know, you got an 80-year-old lady or something that somebody didn't talk to properly, and they said, Sonny, I want my $100,000 back, and they go get it out in the first year, and they get a check for $89,000. You think they're going to be mad? They didn't know. So that's what they're suing over. But I look at it differently. If you understand the surrender value, what I always call it is the guaranteed, it's guaranteed, worst case scenario. Now what's the contract value? We've made an assumption. You can tell I'm kind of conservative in assumptions. I've imagined that the index that you invested in is only growing at 3% a year every year. So if that were the case, at the end of the first year, you'd have $113,000 in the contract value. The income account value is growing at 6.5%. That's the guaranteed best case. It's worth $117,000. That's guaranteed. Is you take this number, and there is a payout rate in your contract, depending on your age, and you multiply it by that. It's used to multiply a factor to determine your income. So let's walk over this and I'll show you. At the end of the first year, Susie calls me up and says, Tony, I think I'm ready for my mailbox money. How much do I get? Well, Susie, your income account value is guaranteed at $117,000. Your payout rate is guaranteed at 5%, so we're going to send you $52.72 for the rest of your life. You'll never outlive it. If you were to cancel the contract, you get whatever's in this column. What's this contract value for? This is the amount of money that would go at death, or if you didn't want to take income, Debbie, and just wanted to sporadically take some money, you could take a 10% penalty-free withdrawal out of there. And then finally, pop quiz, the income value is only used to calculate income if elected. You may never elect income. So let's do a little role playing. Don't Follow the Herd book is on this. We'll see how many people get this right. Shout it out. Susie has had this contract 5 years and dies. Which column does her beneficiary get?
Contract value.
Very good. Let's say you're in the 10th year, 10% penalty-free withdrawal, so you could take $14,700. When I say without penalty, it means the company will send you a check without penalizing you. You don't get into any of these surrender charges. You with me? You do that every year. What they do is they take 10% off of this, which is $20,600, that you will not earn 6.5%, but the balance you would. But you cannot pay it back in. Now, unlike the old annuities, if you started an income, Cindy, you could stop that income. So let's say Susie's drawing $11,356. Unfortunately, Susie gets diagnosed with cancer. She's got 2 years to live, and she says, well, that's not going to do me any good. Can I stop the income? The old annuities you couldn't. This you could stop, and then you could go over and take what's in the contract value. See what I mean? So it's very, very flexible. That's why we call it a hybrid. Any other questions on that? Because that's a very, very important page. I spoke at a large conference full of advisors out in Las Vegas this past year, and that's all it is. I went over this sheet for 30 minutes because a lot of them I know are not explaining this contract properly. Generally, I recommend annuities, large amounts of money in annuities, to be at least 40 years or older. That's what I usually recommend. Okay? Because the payout rates, Allianz has got a new one that's not bad for a younger person. You can put it in. What they do is they guarantee, I think the rate of return, you got to take it out at 59.5 though, I think. It's a 10% simple, I mean, it's a convoluted, but what they're doing is, and I admire them for trying to do this, what they're trying to say is, hey, young person, like I like to say, if you want a pension like granddad's, just put your money in here, and when you turn 65, we'll turn you on mailbox money. I mean, it's a good contract, but it's not like this. A young person couldn't get this contract. So yeah, it's a very good question. Think of this like this company won't even issue a contract unless you're 50 years of age or older. So age has a big bearing on it. Okay, let's go back to Susie. We're in the 10th year. She has 147. If Susie had an elected income and died, she'd get the 147 penalty free. We know that, right? So let's just say, Ms. Titchener, your son was the beneficiary. You pass away, he gets a check for 147. Now, if it's in a non-qualified account, quiz you here a little bit, would you have to pay any taxes on that? She put in 100, it's tax deferred. You'd owe taxes on 47,000. Okay, that's kind of a neat little thought to, okay. Now, Ms. Titchener starts drawing out 11,000 a year. This still would make 3%, but they come in and they subtract the 11,000 from the 147. This is why if a company is charging fees on the income side is always going to be higher. You got to remember the fee is always deducted from here as well. So we have 0.6 on the fee. Well, that's $1,000 you got to subtract. So we take the fee off, that brings it down to 146. 11,000 off that brings it down to 135. And let's just say the market crashed. Would it make anything? No. So you'd still be at 135. So if Susie dies after that year, you would have gotten the 147 less the 11,000 less the $1,000 fee. The market didn't do anything, so you didn't lose anything. So roughly in that case, you get about 135,000. So over time, yes, that contract value will gradually go down. It can't keep up with that kind of withdrawal. I run these spreadsheets a lot. If you're using about a 3 or 4% assumption at the most, it'll last about 15 to 20 years, somewhere in there, and then at some point, there's not going to be any money to heirs. Now, here's the way I look at it. If you made 3 or 4% at the bank, what that proves is, hey, if I took out that much money, in 15 years, my banker's going to call and say, Susie, we don't have any more money. You're done. The insurance company says, uh-oh, Tony lived longer than we thought. Too bad, we lost. He gets that money for the rest of his life. These can also be set up on a joint basis, a little less income for the spouse, but that way the spouse would get it for the rest of their life as well. So you can do a joint annuity from a payout standpoint as long as it's a spouse. And a lot of people like that feature. And you don't even have to claim that now. That's the good thing. You don't have to say, well, I want to put my spouse on there. You do that at the time of the income election. Just like your pension, you decide that then. Any annuity, variable or fixed, especially if it's income rider, the template is the same. Don't let anybody tell you. That's how they work. Now, how they charge fees, the percentages, that's what you got to watch. But that's the template. That's how it works. So,
can you go over briefly again what part of that is taxable?
Yes, ma'am. Now let's talk about an IRA because it's real simple. You can roll a 401k IRA into an annuity. As you know, it doesn't matter what kind of contract or investment you have. The IRA is all fully taxable when you pull it out. Okay. So in this example, if you had this in an IRA at $11,356, you got to pay taxes every year on that, assuming you pay taxes. Okay. Non-qualified, it'd be a little different. It gets a little more complicated because you put $100,000, you'd already paid taxes on that. It's non-qualified. So the insurance company is going to track this and say, well, really they only have a $47,000 gain. So in that example, the first $47,000 that comes out is taxable. After that, the money they pull out is tax-free because that's a return of what they put in anyway. So non-qualified means you'll get your money back eventually.
So the amount you put in is non-qualified?
Yes, ma'am.
It's not taxed?
That's correct.
But they take your gain first.
Yes.
You get your gain before you get
Yes. By the way, the reason I like whole life insurance, people don't know this little trick. I love whole life. Whole life, as it grows, The tax laws say, okay, let's say I put in $100,000 in my whole life policy and the cash value is worth $200,000. I can take $100,000 of cash value of a life insurance policy and they'll let me pull that out first tax-free. So they reverse the order. So I could just surrender part of it. It's called surrendering additions. Whereas an annuity, what you pull out is your gain first, which has to be taxable. Does that make sense? So another feature of whole life that's really good for planning purposes. What I've tried to do over the years is make sure people are clear. What types of money can go into one of these annuities? Money in CDs, money markets and savings? Absolutely. Met with a gentleman the other day. He's got money languishing in the bank. Can I put $50,000 non-qualified? Any amount you want. The minimum account size to open up is $5,000. I like to tell people you need at least $50,000 before you put in an annuity. That's just so you can keep some liquidity. You don't want to put your whole $50,000 in there. So you really need about $50,000, but you can put as little as $5,000 in one of these. Does that make sense? What can I put in there? Can I roll a 401k? Yep. 403b? Yep. IRA, thrift, 457 Roth, anything.
Okay, so I roll, let's say I roll 95% of it, or all of it into that. And then what do I do with the money that I'm popping in there every 2 weeks?
Are you getting a match or?
Oh yeah.
Yeah, you can just keep it going.
Yeah.
You can. I call that new money and old money. You can take the old money and roll it out. The new money, if you need, and I can look at that and make sure you really want the tax. Are you tax diversified? How much of your money is outside the 401k, percentage-wise? Not much. Yeah, see, that's kind of scary.
Oh.
Yeah, may or may not want to put so much in the 401k. I could look at your tax bracket and do all that for you. That's part of the service I provide. So, but yeah, you could do that though. I've had people that need that tax deduction. They got plenty of money. Yeah, well, we might want to leave it alone.
Oh.
And if the match is, no, I mean the old money. Pull that out. The new money you could still put in there if you wanted for your tax deduction. Or we could do. Do you have an IRA on Debbie here?
I do. His is very small.
Okay, but or you could just open up with a rollover. You could just do an IRA contribution if you wanted to. There's a lot of options. New IRA or Roth contribution. Somebody says, well, I just want to put money in a new Roth, $5,000 a year. Yep, you can do that. Existing brokerage accounts, stocks, mutual funds. Can they be liquidated and put in an annuity? Absolutely. Inheritances. Existing annuities. If you decided to do that, absolutely, you can move it over. If it's a non-qualified, it's called a 1035 exchange. We can take a non-qualified, move it into a new non-qualified. There's no taxes to move it over.
Does it have to stay with the same company?
No.
Or if it would be moved to a different company, is the original company going to charge me a big penalty?
The original will.
I tried reading that contract and I got...
I'll help you. Yeah, we'll get it figured out for you so you can make some informed decisions, put it that way. Yeah, Heather's gotten good. She'll just go online and find the prospectus and look it up there because a lot of times the contract won't even tell you everything.
I got
really?
There's a lot to it. And then cash. I wouldn't think anybody in this room would have any cash hoarded up in the vegetable drawer or whatever, but some of you are thinking, I'm getting a little nervous, but you can't bring me cash. You'd have to put it in the bank, then write a check, but you could put it in there, okay? So I just have, if you have one or more of these assets, okay, check the box to meet. There's no obligation. You would check the box. Connie will call you no later than Wednesday and set up an appointment. We meet right down the hall. You heard me talk about cost and saving money. I don't like spending a lot of money on costs. So for years I was the infamous guy that hung out in the back of Starbucks. I had one of the boardrooms.
Yeah.
People would walk by. I had one of my current clients, they're good clients of mine, but their son said, Dad, Mom, why don't you at least go talk to my stockbroker friend? And they said, well, okay. And they told me about it and they acted like I was going to be mad. I said, hey, it's your money. That's fine. So they came back and I said, well, what did he say? And he said, well, he was a nice gentleman. We're not going to do any business, blah, 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 for whatever reason. But said, we did bring your name up. This is hilarious. So this was when I was working in Starbucks in the back conference room, back by the restrooms. But anyway, so at the Starbucks, so we'll get through talking to him. And I said, well, what did he say? And said, he asked again, he said, so what is this fellow's name? I said, Tony Walker. He said, he looked at him real serious and said, is that crazy guy in the back of Starbucks I'm always seeing? So apparently this guy's walking in week after week and I'm back there working away, seeing people up to 10 o'clock. Were y'all over there late at night? I'd be up there to 10, 11 o'clock shutting that place down. So it's been a good ride, but they took the wrecking ball to the Starbucks boardroom. So I've been at the Marriott now. They've got me a private office here. It works great. So you complete privacy. I think it's good to have a small firm if you decide to work with. I call ourselves a boutique firm. Myself, you've got Aaron. Connie was a former computer programmer. strong faith like myself. Aaron's strong faith. Heather's got a strong faith, strong accounting background. Heather's very good. Lee came from the paralegal side of the legal field, so she knows. So we understand confidentiality. We understand keeping things under wraps. We're very protective of information you give us. For those of you who decide to come in and meet, you'll notice you'll have this starter kit. When you come in, you'll bring those documents. If you want me to make copies, I can. If you're not comfortable with that, that's fine, but I do need to look at the documents. I got to look at your tax return. See, just in your example, can you imagine trying to give you advice on whether to fund the 401k without seeing your taxes? It's impossible. So, but that's all confidential. So even after we've met with people, occasionally people decide not to work with us at that time. If you want us to, we'll give it all back. We have a shredding service. Anything we got, we'll shred it immediately. We don't, we're not here trying to hang on to people's information. So know that everything is very confidential. I'll stay around for any questions that you might have. Otherwise, thank you for coming.